Welcome to the deep dive.
Great to be here.
So today we're tackling some really interesting ideas, stuff that kind of makes you rethink things you maybe took for granted.
Like the U.S. financial market being, stable and predictable,
Exactly. We've got this opinion piece. It's pretty punchy. Basically asks if the U.S. is now behaving like an emerging market.
which is quite a take.
Right. And then we'll also get into some commentary from Bill Gross, the bond king.
Yep. Known well.
He was talking about how political moves are, well, injecting a lot of volatility and what that means long term, maybe especially for younger investors.
Okay. So two related but distinct angles on market stability or lack thereof.
Precisely. So our mission, let's say, for this deep dive is to really dig into these maybe surprising viewpoints.
And figure out what they actually suggest for understanding the market today.
Yeah, and how you might think about risk. Okay, so that first idea, the emerging market concept.
It does immediately grab you, doesn't it? Given, the U.S.'s historical position, it feels contrarian.
Totally. So this Market Watch piece, it lays it right out there. The headline practically shouts, "The United States is now an emerging market. Invest accordingly."
Wow. Okay. No beating around the bush there.
Not at all. And the core of their argument, it seems, is pushing back hard against that old idea. You know the one.
Uh-huh. That U.S. stocks are basically a sure thing for high returns, like 10, maybe 20% a year without massive risk.
That's the one, that dominant narrative. The author says maybe not so much anymore.
Right. Questioning if that whole low-risk, high-return combo is still, well, reliable for the U.S.
It's a big shift from what many people just assume, I think.
Definitely. A real departure.
And it's not just theoretical for this author. They actually say they have zero investments in U.S. stocks right now.
Seriously. None at all.
That's what it says, zero.
Yeah.
Which, that makes you sit up and pay attention, right?
It certainly does. That shows some serious conviction behind the argument.
Especially considering their background. They're an award-winning financial writer, former analyst. Adds a bit of weight.
Sure. It's not just some random person yelling online.
Okay, and then there's this comparison they make. It's pretty stark. They say the U.S. is basically an emerging market,
Okay.
but one that sells for about 50% more than developed markets.
Whoa. 50% more. That's a huge valuation gap. What's the reasoning behind that claim?
Well, they argue that premium, that extra cost, it's kind of propped up by things like, the past performance of the big tech companies.
Okay, the F.A. Yangs and their successors.
Right, and the dollar being the reserve currency. But the author suggests these foundations might be getting a bit shaky.
So the idea is that the price you're paying for U.S. stocks doesn't really line up with the actual risk and the likely future returns, especially compared to other developed countries.
That seems to be the core of it, yeah. A mismatch between price and realistic expectation.
Interesting. Okay. That's a lot to chew on just there.
It really is. Now let's pivot slightly. Let's bring in Bill Gross.
Right. The commentary on political influence.
Exactly. His focus was very much on how actions from the political sphere, specifically from then President Trump, were creating waves, serious volatility in stock prices.
And this wasn't just general commentary, was it? It was tied to a specific event.
Yes, exactly. It followed Trump's announcement about pausing tariffs for 90 days. Remember that?
Vaguely, yeah. Trade wars were definitely a big theme then.
Well, this pause announcement, it triggered a massive market reaction.
Okay, how big are we talking?
Huge. Gross pointed out the S&P 500 had its biggest single-day gains since the 2008 crisis.
Wow, since 2008. That's significant.
It was up 9%. The Dow jumped almost 3,000 points. The Nasdaq, 12%.
Good grief. Those numbers really highlight how sensitive the market was to that kind of news.
Totally. Especially trade-related news. It shows just how interconnected politics and the markets had become.
You can really see it there.
So it's against that backdrop, this huge surge, that Gross asks this really pointed question. I think it was on social media.
Okay, what did he say?
He wrote something like, would you want to own highly volatile U.S. stocks whose price depends on whether PDS had a good night's sleep and woke up the next morning to reverse yesterday's policies?
Oof. That's blunt.
It really is. It's vivid, right? It kind of captures that feeling of uncertainty that policy could just flip overnight.
It absolutely does. It brings that sort of human, unpredictable element right into investment decisions, moves beyond just looking at the economic data.
Yeah. And he wasn't just talking theory either. He actually mentioned his own portfolio at the time.
Oh, What did he say about it?
Said it was green, meaning profitable, because he was holding defensive stocks.
Ah, okay, so he was practicing what he preached, essentially, positioning himself for that volatility he was warning about.
Seems like it. It wasn't just abstract commentary, it reflected his actual investment stance.
That adds another layer, definitely.
Yeah.
Shows he put his money where his mouth was.
Now, Gross also took it a step further. He wasn't just looking at the immediate reaction. He raised concerns about the longer-term impact
On whom specifically?
on younger investors, like millennials and especially Gen Z.
Okay, why them in particular?
Well, the thinking is they might have less experience with big market swings, right? And maybe they came into investing when things seemed easier, more predictable.
Right, perhaps during a long bull run. So a sudden shock could hit them harder, psychologically too.
That seems to be the idea. He actually said, and I'm quoting loosely here, that this kind of market crash or volatility will affect these younger generations for a long time. What looked like a can't-miss way to make money
Yep.
will instead make them more cautious, more conservative.
Leading to potentially different investment behavior down the line.
Exactly. He predicted it would result in lower PE ratios, people paying less for earnings.
Right, less optimism about future growth.
Higher yields, presumably on safer assets like bonds, and ultimately low single-digit returns for stocks overall.
Wow, that's a pretty sobering forecast for future returns. Suggests a fundamental shift in investor psychology, particularly for those just starting out.
Yeah, the idea that what seemed easy could breed lasting caution. It's a powerful thought.
It really is. A potential long-term scar, so to speak.
Now, it's interesting because not everyone saw that tariff pause the same way Gross did.
Oh. What were some other reactions?
Well, the source material mentions Bill Ackman apparently called it the art of the deal.
Okay, seeing it as a negotiating tactic.
Right, and Friedrich Merz, a German politician, reportedly saw it more as a response to European determination.
So, very different interpretations of the same event.
Exactly, which just goes to show how complex these things are, right? How people see the same data through different lenses.
Absolutely. Politics, economics, market reactions, people frame them differently based on their own perspectives.
Okay, so let's try and pull this all together. We've got the U.S.'s emerging market idea and Gross's warnings on political volatility. What are the main takeaways here for listeners?
Well, I think the biggest thing is this questioning of the old certainties.
Right.
Both arguments, in different ways, suggest the U.S. market might be entering a period that's maybe more turbulent, less predictably high growth than people have gotten used to.
That assumption of stability is really being challenged.
Definitely. And Gross's point about political factors driving volatility seems particularly relevant today,
Yeah, it feels like that hasn't gone away, and this could genuinely change investor behavior, couldn't it? Especially younger investors.
That's his argument, that increased volatility could lead to more caution, more conservative strategies, less willingness to pay high multiples for stocks.
So maybe a shift away from just assuming buy the dip in U.S. stocks will always work out quickly.
Potentially. It encourages a more, let's say, critical look at the underlying risks, including those political or policy risks, not just the economic fundamentals.
So connecting this back to the listener, what does this mean practically?
Well, it might mean, first, just re-examining your own assumptions. Do you implicitly believe the U.S. market has to deliver high returns with low risk forever?
Good question.
Second, it maybe reinforces the case for diversification, not just within the U.S. market, but maybe globally, across different asset types too.
Spreading the risk.
Exactly. And third, it really highlights the need to factor in that political dimension. How much potential policy whiplash are you comfortable with in your portfolio?
That's a tough one to quantify, but yeah, definitely something to consider.
It really brings up a key question.
Yeah.
How much are you letting those kinds of geopolitical or sudden policy shifts influence your own investment choices? And are you okay with that level of potential volatility?
Yeah. It's not just about PE ratios anymore.
Not entirely, no.
So, wrapping this deep dive up, the main theme seems to be that the conventional wisdom about the U.S. market is, well, getting some serious pushback.
From experienced voices, too. It's not just noise. It's a call to question those deeply ingrained assumptions about the U.S. as this guaranteed safe haven for growth.
Requires more critical thinking, maybe?
I think so. Essential in today's world, really.
So, maybe a final thought for everyone listening to consider. Given everything we've discussed, the potential for more volatility, the influence of non-economic factors, how does that change how you think about investing?
Yeah, how does it impact your personal approach to risk, your strategy?
Definitely something to mull over. We'd encourage everyone to, keep exploring these ideas, look at different strategies, and just think critically as you navigate things moving forward.
Sounds